All right, so we are going to be on our last video for chapter 1, and we're going to talk about, we've been talking about the conceptual framework, and here we have some of the underlying assumptions. Some of these might look familiar because we talked about a few of those in Principles of Accounting. So the first one's economic entity. This assumption presumes that we are keeping economic events that can be identified to each business separate, okay? So if I have Solano's income tax preparation and I have my personal bills, I need to keep my business stuff completely separate from my personal stuff. Get a checking account just for that business. Keep those transactions there. If you have two businesses, you don't want to commingle the bills between each one of those. Okay. They need to stand by themselves. Okay. So going concern, this just means that we look at a business is going to continue to operate indefinitely. I don't know about indefinitely because we don't really know much more than, a few years out. But a lot of times they limit that to 1 year. What's going on in the financial statements right now, are they going to still be in operations at least in the next year? So yes or no. Okay. Then we have the periodicity principle, and this is where we've just divided all these transactions up into these time periods. It could be a month, it could be a quarter, half a year, or a year. Okay. Have to have at least yearly financials because the IRS wants to know how much money we made. Okay. Monetary unit is just the dollar. We use the US dollar because we are in Arkansas, which is part of the United States. So we use the dollar. Okay. And our dollar is relatively stable. We are always going to have a little bit of inflation, but our monetary unit, the dollar, is pretty stable as far as inflation goes. Okay. So that was part of the recognition, measurement, disclosures, and concepts. Okay. So recognition refers to the process of actually admitting information into the financial statements. Okay. Sometimes you will hear the word realized versus recognized. Okay. Kind of think about the two different things on there. So I have a house and I have more, my house is worth more than what I owe on it. Okay. I sort of have a realized gain, but it's not really recognized yet. Okay. It's not a formal thing. It's not going to be a formal entry until I sell it and I make that money. Okay. So sometimes realized doesn't necessarily mean that it is recognized. Okay. Measurement, the process of associating numerical amounts with the elements. Disclosure, we want as much disclosure as we possibly can get. We want lots of transparency. We want to be able to know every little thing because if it would change our mind on investing in this business, then it needs to be disclosed. Okay. All right. So revenue recognition, I just talked about realization. I didn't look ahead, did I? Revenue recognition has been kind of a hot topic in the accounting world for the last few years because it came in and kind of set some different standards. Um, Probably nothing that was probably change a principles book, but maybe a little bit in the intermediate book because we had a lot of businesses like they may have contracts and they may have within that contract, they may have several different services. I always think of like technology. So you might purchase this computer system, and with that computer system, you have installation and you may have some training. You may have training on it for like 2 years. Well, GABA's came in and said, you need to recognize those all separately. Okay. If they're each separately, you can figure out what the sales price is, then you can get a percentage. Okay. So it kind of led to maybe the net income wasn't changing, but it made sales look really, really high. But, maybe it didn't really change net income very much. So it's kind of inflating those upper numbers. Okay. Also, you can rent a hotel room through Priceline.com and some of these third parties. Well, some of those third-party places, they were like, just say for instance, the hotel room cost you $100 a night, and they have to remit 90 of that to the hotel. 10 is what they made. A lot of them were coming in here and saying, "Oh, we've got sales of $100, but then we have an expense of 90." We still get to the 10, but that number was very inflated. Okay, so that's why there's been a lot of talk about revenue recognition. Okay, companies recognize revenue when goods or services are transferred to the customers. The customers have the risk. So if something goes wrong with it, it's in their possession. They have risk of loss. That usually will tell you if a sale has been generated or not. If that customer has not taken the risk of loss on that item, then it wasn't a true sale. Okay. So remember expense recognition. Sometimes this was called matching back in the day. Matching principle and expense recognition mean exactly the same thing. Okay. Um, we do have some different approaches on it based on exact cause and effect relationship. It could be just associating an expense with revenues. It could be a systematic rational allocation, and it could be all of these. Okay, it didn't have to be just one of these. It can be all of them. In the period incurred without regard to the related revenue. Okay, so we're just trying to match those expenses with the revenues that we earned in that period to get that true accrual-based accounting. So remember, if you take revenue recognition, expense recognition, putting them together, you get accrual-based accounting. Okay. All right. Measurements. GAAP currently employs a mixed attribute measurement model. So we have some attributes here. So we have historical cost. Historical cost is a very good number because we know exactly what that number is. It's not an estimate. We know exactly how much we paid for a building, for a factory, or a piece of equipment. We know that. That's a number we really know. But is it the best number to use later on? I don't know. That's where IFRS comes in, and they kind of change the rules just a little bit. Okay. There is net realizable value. Okay. You may remember when we had accounts receivable minus that allowance for doubtful accounts, we could have net accounts receivable or net realizable value. Okay. Current cost, the cost that it would be incurred to purchase or reproduce the asset. Okay. We have present value. Present value would be taking all of the cash flows and discounting them back to right now. Okay. So just say, for example, you're going to buy a building and you're going to make so many payments every month, but you don't really know how much you paid for that. You just have this number on how much you're going to pay over, say, 20 years. Well, you can use time value of money and you can discount that back and find the present value of those cash flows. And then that will tell you what that asset is worth or how much you are paying for it literally today. Okay. Fair value, this is usually not the same as book value. Okay. This is where I try to caution students because a lot of students get confused. They think that because they went and traded their car in and they called it book value doesn't mean the same as our book value. Okay. That's really fair value when you do that. That is really fair value. Fair market value is sometimes the term used. Okay. Book value is just what it's being carried on your books as. Okay. Okay. We kind of talked about historical cost already. Bases the measurements on amount given or received in the transaction. For assets, I kind of mentioned, we can use that time value of money, discount it back. For liabilities, we can look at the current cash equivalent received in exchange for assuming a liability. We also have long-lived revenue-producing assets, equipment, all those property, plant, and equipment things. Okay, that can be adjusted subsequent to the initial measurement by recognition of depreciation or amortization. Okay, remember amortization is for intangibles. Depreciation is property, plant, and equipment. Okay. All right. Moving right along. So we have net realizable value. What does that mean? Okay. This is, in this case, estimated selling cost in the ordinary course of business, less any reasonably predicted cost of completion. Okay. That could be like packaging it. It could even be there could even be some like if a salesperson's going to get a percentage of the sale, that could also be in there because that's going to be an expense to them. Okay. They'll look at disposal and transportation. Okay. The net amount of cash in which an asset or liability is expected to be converted in the ordinary course of business. Current cost that would be incurred to purchase or reproduce the asset. And then we have the present value. I'm not sure what they're talking about right here. That must be a standard or something that they have there, but we are going to get to in a couple of chapters, we're going to talk about present value. Most of y'all in intermediate will get to do time value of money in financial management as well. Okay. All right, so there's a couple of ways that we can apply fair value to some of these assets. So we can use the market approach. What is a similar item being sold out on the market? It could be income approach. How much earnings are we going to make off of that? Or it can be a cost approach. Okay, so I'm going to skip over those because these videos get kind of long. So we have this fair value hierarchy that they give us and another question. And then we're almost done with this chapter. Fair value option. This is one of those things, I may have mentioned it before. Um, there are some financial assets that can be, that we can write them up. This was sort of a convergence on an issue between GAAP and international standards. Things like some stock bonds. It's real easy to get what is the fair value on those items. Some things it's really hard to get a fair value on, like a building that's been sitting there empty. Okay. Things like that. But yeah, some of these financial assets like stocks and bonds, then it's a little bit easier to actually get what the fair value is on that. Okay. Full disclosure principle. We want everything to be disclosed. We want lots of transparency. It could be parenthetical comments, or it can just be saying, see note one about whatever this issue is. It would also have any supplemental schedules and tables that support the financial statements. There's a lot of things that go into the annual report that aren't just numbers. Okay. So they give us this little summary of the recognition, measurement, and disclosure concepts. And I wanted to jump over just a quick second to let you see the entire conceptual framework. They may be going to show us this at some other point, but I wanted you to kind of see that. We've talked about those economic entity right there, going concern. We just talked about all of those. We've talked about that. This is how it all fits together. Okay. We have all those qualitative characteristics. We have these elements that we talked about in this chapter. We have talked about everything here, but I just didn't see a slide that showed every bit of it to you so you can see how it all fits together. Okay. All right. And I've kind of already mentioned how this revenue expense asset liability approach, this is evolving as we speak right now with GAAP, and it's evolving. You know, there's still an effort to converge GAAP and IFRS. Okay. And that is all for chapter one. I will see you in chapter two.